This is David Goldman, Asia Times Deputy Editor, speaking to you from New York City the evening of May 19th. The excitement in today's markets, apart from the wild ride of Bitcoin, which we won't talk about here, was from the Federal Reserve, which released minutes today of its April meeting. And at this meeting, some Federal Reserve governors said that it might be appropriate at a future meeting to begin discussing a slowing of the rate of asset purchases or quantitative easings. Note that they didn't propose to do anything, simply to, at some future meeting, perhaps begin talking about it. However, the whiff of a change of Federal Reserve policy was sufficient to push up bond yields and push down stock prices, though the very namby-pamby character of the statement wasn't enough to cause a real strong market move. Stocks recovered most of the ground they'd lost. That's not the real news. The real news is that the inflation measures, which are driving consumer price index increases to their worst results since the 2008 financial crisis, are getting worse. The big news in the consumer price index number that came in last week well above expectations was a 10% rise in used car prices. If you look at the chart of the day, the well-respected Manheim Index of used vehicle prices has risen 50% this year, and the latest reading we have for the first half of May shows the index going vertical. This is a supply chain breakdown of the worst order. American car companies can't get the microprocessors, the computer chips, which govern most of the vehicle's functions. So car production is down roughly 20% in the first quarter. Rental agencies can't find new cars, so they're bidding for used cars at whatever price, and the price of used cars is going up spectacularly. And although we see that the consumer price index has registered a 20% increase over the past year, the actual price of used cars at the wholesale level has roughly doubled. So we have a great deal more inflation in the pipeline there, and the same is true for many other critical measures of inflation. The most important component in the U.S. Consumer Price Index, of course, is shelter. That's about a third of the index. Now, there are two U.S. government measures for shelter. One is the Census Bureau's report of the median asking price for rents in the United States. That's up nearly 20% year on year. And then you have the Consumer Price Index component for rent. That's up less than 2% year on year. Somebody is missing a zero somewhere. And what typically happens is that when you have shocks like this to prices, it takes 6, 12 months, maybe even longer for the consumer price index to register it. So I think inflation is going to be running at a steady 5% annual rate towards the end of this year, and the market will have many more bad hair days like this one when it considers what the Federal Reserve will do to stop inflation. Eventually, the Fed's going to have to do something. The results will be ugly. It'll take a while. So, in the meantime, hedge your portfolio, be cautious, and be afraid. Be very afraid. This is David Goldman speaking to you from New York City.